If you buy a property, let's say $100,000, and you sell the property after 5 years and it sells for $150,000, will I be taxed on the $50,000 of gain? And will I get my $100,000 back without paying taxes? Do you want to play with this one?
Yeah, I mean, let's look at the easiest scenario that you bought $100,000 worth of land. You're speculating on the price going up. 5 years later, you're able to sell it for $150,000. You're going to be taxed at capital gains rate since it was an investment on the $50,000. So we're talking the long-term capital gains rates, which is either going to be 0, 15, or 20%.
Yeah.
Now, let's say if your investment is a rental property, anything you might be taking depreciation from.
That's the big one. So you have it for 5 years and you may be depreciating this puppy.
Then you're going to have the $50,000 in capital gain, but you're also going to have some depreciation recapture. That is, you're going to have to recognize as income what you've previously depreciated.
Yeah. So in English, because this gets really murky, if you buy a rental property, you have a house on it. The IRS says, hey, that house is going to last 27 and a half years. They're omnipotent. They know how long it's going to last. So they let you take 127.5 against whatever income you're generating and write it off. That's called depreciation. Whether you make $1 or not, you're getting that depreciation. It's just whether you're out, how you're able to take it. In addition, you have all that gain. So you actually, so Jeff's absolutely spot on. The return of your capital, what they call the basis, you're going to get back tax-free. Any depreciation, you're going to pay whatever bracket you're at, capped at 25%. So it could be at 10, 12, it could be at something lower, but it's going to be capped at 25%. And then you're going to pay long-term capital gains on the rest, the 50, and that's going to be at either 0, 15, or 20% plus your state taxes.
Right.
Plus, if you make too much money, then the net investment income tax, it's another 3.8. You make over $250,000, I think. Is that right?
Yeah, that is right.
Right. Yeah. We throw this stuff out there. We just sit here and banter back and forth. He's looking at me like, what the hell are you talking about?
I thought you were going to say the accountant sometimes gets murky.
Yeah, no, it's fun, but I think accountants get murky. Somebody asked on that previous question, by the way, what about if you have an LLC, not a C Corp? An LLC does not exist to the IRS. So the easiest way to think of an LLC is it's a wrapper. The IRS says, I don't care what the wrapper is, what is inside, and you tell it. It's a partnership. It's ignored. It's a corporation. It's an S Corp. It's a C Corp. So an LLC just means that the IRS needs to be told what it is.
Yeah, and one thing on these C corporations, while they do recognize capital gains and losses, there are no special rates for capital gains and losses.
Yep. Somebody also asked about that same previous question. Do they know whether it should be an LLC or Inc? If we're asking the same thing, I would make it a C Corp just to be safe, because now we're not worried about any flow through. Yeah, Jim, same thing as if you have an LLC, it's disregarded and you own it, then it's a sole proprietorship. So we'll keep jumping on these ones. Oh, and somebody just said, hey, on this question, that's the last question they had, there was a 1031 exchange. So you wouldn't pay any tax if you 1031 exchange it. As long as you meet the 1031 exchange rules, you roll forward the basis, which is you're not going to pay any tax on the depreciation or on the capital gains. You just roll that forward into the next property. That's kind of an interesting mix. You don't have to worry about it. Just make sure you do your 1031 exchange. All right.